CRIF presents How India Lends in association with CNBC TV18.
Hello and welcome to our special show, How India Lends, a report presented by Credit Bureau CRIF and CNBC TV18. CRIF has just released its latest report on India's lending ecosystem for the July-September quarter, and the data is actually pleasing. Total retail loans have grown by 18% if you took the entire AUM, and some categories like gold loans are showing a huge 36% growth in AUM. Despite this robust loan growth, the percentage of defaults or overdue loans has actually fallen to 3.4% in the second quarter for retail loans from 3.6% in the first quarter, in the April-May-June quarter. To decode the key facets of India's retail loan scene, we have a stellar panel with us today. The author of the CRIF report, Sachin, Seth, who is also chairman of CRIF Highmark and the regional managing director. We also have with us Rajan Pental, the executive director, Yes Bank, Arvind, Kapil, MD and CEO of Poonawalla Fincorp, Tushar, Aggarwal, founder and CEO of Stashfin, and Alok, Mittal, co-founder and executive chairman at Indifi. Gentlemen, thank you very much for your time. Sachin, you have to lay the ground since you are the author of the report. What would you say are the key takeaways of the retail loan sector in July, August, September?
Thank you, Latha. My pleasure to be here with all the eminent panelists. So as you briefly mentioned, I'll just take a little bit, I'll expand it a little bit more. This quarter has been far better. I know we have had tough times for last about 14 to 18 months. But this quarter has really shown that, we are probably at the end of the worst, times, and things are looking up. So as you rightly said, 18% growth on overall retail loans. And for the quarter growth also was about 4.5%, which is good. This was also taking into account that, there was a little bit of a delayed purchases in the festive season because of GST 2.0. So we could get 8 days only, wherein, the data would come in. And I'm sure the data coming in later would reflect more on the segments, especially on consumer. A very interesting thing also that PL, credit card, both have shown improvement and uptake. And also gold loan, which you talked about, is already there. But yes, it is not growing quarter by quarter as it had grown already in the past. And auto, two-wheelers, everywhere, things are becoming better. But yes, there is a bit of stress in, two-wheeler side and a couple of other segments. But this is where I would say it's an overall summary of the report.
You pointed out very correctly that, July, August, September quarter, 18% retail loan growth is good because mostly people would not have done too many purchases from August 15 to September 22nd because everyone knew a GST cut is coming. So, Rajan Pental, to you, if you can give us an idea of how it was during the festival season, should we expect October, November, December to be far better than the previous quarter?
So first of all, H2 is always a better, part of the year as compared to H1.
Yes.
So we anyway see a surge, in the number of retail loans across. Economy anyway moves.
No, that's true. That would be year on year. But what I'm asking is if this year it will be something special, the festival season, would it be far better than the previous?
So I think there was a wonderful plan laid out by the government with the, change in the GST rates. And, you could see across that the items or the item prices have dropped, ranging from consumer durable to the automobile. So that spiked up. The festive season had its own euphoria. So I think the festive season was far better. And I know of many manufacturers as well as the retailers keeping their fingers crossed as to what is going to happen during the festive season. But I think the response was maybe 2x of what they actually expected. The second thing also I want to add was that this was a very uniform growth. So the growth actually was led by all products put together and not just one or two products.
Let me put the same question to Arvind as well. Arvind, if you have to quantify, how much better would Q3 be compared to normal Q3s or compared to Q2?
I think first of all, let's understand Q2. I think Q2 itself, I think in our assessment at the ground level was looking, there's a clear uptick. Whether you call it robust, I could see that moving slightly upwards for us. And I can clearly, at least in this quarter, Q3 clearly looking slightly more uptake on a year-on-year basis as well, which means in our assessment, your optimism on the market at large should be much more trending upwards. And we expect probably Q4 should be much more visible of the next 12 months to come as well. So we share a little optimism, Latha, across board, especially consumer durable, personal loans. The more granular loans have definitely, whether it's the middle class or just a notch below, I think there is a clear bias to more granular loans showing an upward trend and a notch better than better.
Okay, that's good to hear. If there is clearly a spring in the step. Let me come to Alok. Alok, the SME sector, according to the CRIF data, the sole proprietor loan has grown by 24.6%. I mean, almost 25%. Fairly decent number. Did you see an uptick in SME loans in Q3 as well?
So, Q3, we have seen a bit of an uptick in the SME loans. And really, I think both the MFI and the SME sectors have gone through a credit cycle over the last 12 to 18 months. Even if you look at the CRIF report, you will notice that the value growth in loans is much higher than the volume growth. So what has gotten cut is the bottom end of the pyramid in terms of lending. So there is value growth at the middle to high end of the SME spectrum. But the NTC growth as well as the lower ticket size growth is still anemic.
Okay. Just for our viewers, NTC is new to credit. Loans have not been too many. In fact, that is a theme that runs through the CRIF report. New to credit, people who are taking first-time loans have been less across categories. So clearly, lenders have been cautious. Let me ask whether that was the position in Stashfin as well. Is that the experience that personal loans of the higher values did well, but not the lower values?
Seen is three broad trends. As a digital lender, we get to see across geographies, PIN codes, trends across the country. So we don't have any branches, and consumers come to our app and they can apply for credit and other products. We have seen demand grow up through the roof. We see about 2 million downloads a month for people seeking credit products or alternatives to credit. And our biggest segment of growth has been what we internally call the A1, A2 segment, which is typically consumers with 750 plus in their bureau scores, and they have what we internally again call thick file. People already have a credit history with larger banks or NBFCs. We have chosen to prioritize those consumers because we have richer data on them, and our approval rates have been less than 1 to 2%, partly because, as other panelists also made a point, that NTC or new to credit is something which we're not focusing on at this point in time. So 1 to 2% growth, approval rate, and clearly about 40% growth in higher ticket, higher quality segments is what we've seen in the last quarter.
So you've chosen to play safe, but the CRIF report shows that loans below 1 lakh and 1 to 2 lakh are actually showing higher stress. Did you see anything of that kind?
So I think that's one dimension of the way to look at the consumers. We have chosen to work with consumers who have a rich credit history going back at least 3 or 4 years.
So this was not your experience?
And in that case, that's not been experienced yet. The ticket size is actually not a true reflection of what we've seen as delinquencies or non-performing assets in our segment.
Okay. Well, the other area which showed stress according to the CRIF High Mark report is auto loans. Rajan, would you want to comment on that? They are the only area where the Q2 stress is higher than Q1 is in auto loans, especially in second-hand car loans. Is there a problem there? And the other one, of course, is also two-wheelers.
Yeah. So, whenever there is a cycle starting, you will see that most of the companies will pull back, look at their credit scores. So there is also a denominator effect. So if you look at the auto sales were actually not very good in the last 1 year, and even in two-wheelers as well as used cars, the financials have been more cautious So there is a denominator impact also on some of these segments, what you said. But the second part also is that the cycle for the last 3-4 years has been so good, and there have been some relaxations, and obviously that has played out on the default. But if you look at the portfolio which has been acquired maybe more than a year back, and what has got acquired by various banks or NBFCs in the last 1 year, the behavior of the portfolio is very different, and that is largely because a lot of control measures have come into a play. And
Okay.
if you watch retail industry, that actually
So you mean
works like this.
newly given loans are behaving much better than the older loans?
Much better, much
Yeah,
better.
actually that the CRIF report shows that 180-day plus default is actually behaving worse than, the 31 to 90-day defaults. It is overdue loans, but, that number is going down. Actually, a similar question to you as well, Arvind. Did you notice, the stress areas, if anything, according to the CRIF report, is in second-hand cars, in two-wheelers a little bit, and in tractor loans. Anything to share on this? I mean, did you see it continue in Q3, Arvind?
Latha, if you allow me, I think our observation shows not only these, I think there's a growing pattern in the industry. Even if you add to these set of products, you add the SME loans as well. Broader, we are noticing that I think the over leverage position across the industry is something one needs to, as retail lenders, take a note of.
Yeah.
And I think most companies need to add or beef up their early warning systems to make sure you're on the better side of credit when it comes to lending. So I think if you look at, like, for example, used cars, even if you took a specific example, I think if you do pure used car lending, I don't see a concern. But if you mix it with a slight, without a discipline of sorts, and you start over leveraging because you feel comfortable with an asset back and start diluting the LTVs and stuff, then you could walk into a slightly over leveraged situation. And similarly, the industry is slightly getting into a notch into consumerism. So there could be a little multiple loans, which I think it's important to have a more disciplined credit approach or underwriting approach by most banks or finance companies.
We have to take a quick break, but we continue with the other takeaways that we have got from this excellent report from CRIF on how India lends. After the break.
CRIF presents How India Lends in association with CNBC TV18.
Welcome back to our special show, How India Lends. This is a report prepared by CRIF. The show is presented by CRIF and CNBC TV18. Sachin, to come back to you, anything positive or negative that you can tell us about asset quality?
Well, Latha, I mean, obviously, every segment has its own nuances. What I would say is that we did talk about used car loan, and I think Arvind did throw light on that. But used car, while there are areas of concern, but then the portfolio size is very low, actually. It's about just 0.8 or 1% of the portfolio. So I just wanted to highlight that point. From asset quality perspective, if you look at it, there are certain pockets of proprietorship loans, or what we call an MSME, a micro loan or a small business loans. Definitely, they are a little bit more stressed out compared to a mid-tier kind of loans which are there. Definitely, quality in terms of unsecured loans continue to be a bit challenging, and that's why, as we have seen, Alok and everybody has told that there has to be a cautious approach people are taking through. But in general, if you ask me, there is no glaring situation in terms of any broad-based asset quality issues, which we have seen in microfinance, which we have seen in a couple of other sectors in the past. I think last 14 to 16 months have been a lot of tightening, controlling, and prudent behaviors by across the ecosystem. So at this moment, there's no alarming signal on asset quality on a specific sector.
Okay, actually that's very good to hear, and I think your data also shows that if anything, the what you call portfolio at risk for 31 to 180 days has actually gone down to 3.4% compared to 3.6% in the previous quarter. So stress for retail loans as a whole appear to be declining. One standout part of the CRIF Highmark report is the rise of gold loans. Arvind, is that the observation at Poonawalla Fincorp also? And what accounts for this, 36% rise year on year in the AUM of gold loans? And if you only took loans originated, it is a 53% rise. Can this pace continue also?
I think very interesting space, Latha. I think we love this asset class, and I think so does the financial sector. But if you look at it, most institutions find it attractive because if inflation, economic uncertainty, and the central bank demands cross, so all of which tend to kind of give it a safe haven kind of feel. But there are very few asset classes in the financial sector which start rising. Most of them actually decline after you lend.
Yes.
Even if you look at the interest rates, I think kind of gold gives you a fantastic stability. So in a diversified portfolio, I think I think the industry is very bullish on it. Fair opportunity for penetration levels. If you look at India in particular, and especially I run an NBFC, so I think we believe that that's a huge positive strength in an entire retail lending that gold can add. It's also a very fantastic geographical spread.
Okay.
So
Yeah,
I think from all aspects, there is a clear bullish trend for the next 5 years as well.
Okay.
Even if it doesn't rise to that order, even if you notice carefully, the regulator has narrowed the gap
Yes.
in terms of the discipline of lending on gold for NBFCs and banks. And I think that will also help the industry at large.
Yeah, it's actually a personal loan, but it's got asset backed. So why would not a lender want it? And as you say, one of the few assets which rise after you take it as a collateral. So everything going for gold, and it is likely to continue to do well. Rajan, Pental, I wanted to ask you, the CRIF report shows that actually PSU banks have taken a lot of space, a lot of the market share in home loans and of course in, credit cards as well. Even in auto loans, they're not bad. The big ones where private banks are still dominating along with NBFCs is auto loans and, credit cards as well. Why is it that, home loans is not as attractive a space for private banks?
See, first of all, home loan is a very tricky product, and most of the people on the panel have done home loans for a large part of their life.
Okay.
The kind of, the deposit cost, whenever it goes up, the margin shrinks because the rates in home loan does not go up commensurating. So I think this is one of the reasons that, banks are not that aggressive as they used to be in the home loan segment.
Okay.
So that primarily is the reason. But, with the deposit rates again going down, I'm sure this is always a very dear product for all the banks because it is a long-term product and it brings a lot of stability to the portfolio. So that could be a reason you would see, some quarters here and there. But I think all private sector banks, PSU banks, as well as NBFCs would find it attractive as long as it fits into their portfolio level strategy, right? As long as it gives the commensurating yields and it keeps on giving the stability, this will always
point taken. So home loans normally are a low NIM, low net interest margin product at a time when you've got a slash in repo rate. Obviously, for banks, this is not a favorite sector. I guess after their deposit costs fall, it will once again become a favorite sector. The other thing, Rajan, I wanted to ask you, credit cards have moderated. Any reason why?
I think, one of the things which I want to highlight is that it is never the product which defaults. It is the customer who defaults.
Yes, of course.
Right? And customer always has a hierarchy of repayment also, right? It's like we look at demand, even the repayment is also a hierarchy. And in that, the lowest one is always the credit cards, where the default always hits the highest. There have been a lot of steps to correct the sourcing of the credit cards. That is number one. Number two is that the banks, wherever, there is a default cycle rising, your revolvers would actually start defaulting and you want to really cut it off, right? And this is where the basic concept of over leveraging starts from, right? But the last 2 quarters have been promising, and going forward, not only on the new acquisition but also the portfolio corrections which was to happen have happened. So you will see our aggression again coming back, but it will be slow but more firm as compared to what it was before. So both personal loans and credit cards, I think 1 or 2 quarters is maximum when you would see a stress, and then it should start slackening and then rising from there on. But on a much firm background, because people have taken all the corrective steps what they had to take.
That's good to hear. We are actually running out of time. So very quickly, Tushar Aggarwal, are you getting a sense that you may see a step up in loan demand and that you will have the confidence to move to lower echelons as well?
We are seeing two broad trends happening in the last 1 year or so. One of them is premiumization, where consumers who are ordinarily thick file are sort of willing to pay a slight premium for instant or quick decisioning, which we did not see in the past. So they're not as much value seekers, even though they have other competing options. The second trend we are seeing is that DIY. So we as a firm are self-serve only. There's no calling function or assisted sales function. And in the past, we used to see resistance from people who were credit-worthy, who are ordinarily used to, let's say, banks or larger institutions to offer them some degree of support or assisted sales. We're seeing a big trend where people are sort of just doing a DIY and are willing to come on the platform and fill the journeys themselves.
Well, for those who are new to this newfangled language, DIY is just do it yourself. And Tushar says there are more such people coming in. A final question to you, Alok. Was Q3 better than Q2 for SMEs? One got that sense from people who said that, if you looked at the Diwali gifts, that amount of gifting went up substantially this year, according to market sources. And most of it are small scale items, from packaging to diyas to the entire paraphernalia. Was it reflected in your loan demand?
Absolutely. And we tend to see the loan demand from MSMEs slightly ahead of the festive season, because that is when they are planning for the festival sales. So we did see a jump up in September and October in run up to the festival season. I think, one of the pieces that obviously at this point is somewhat uncertain is the export scenario in segments like textiles. So we saw a bit of muted behavior there, but by and large, the Indian consumption-oriented MSMEs did see a good, strong festive season.
All right. On that optimistic note, we wind up on this conversation. Thank you very much, Alok, Tushar, Rajan, Arvind, and Sachin Seth, of course. I am looking forward to the third quarter CRIF report on how India lends, because this is the quarter where we have so much optimism on how many loans were lent and how good was the quality of loans. So look forward to the next edition of How India Lends. Thank you very much for joining us on this conversation.
CRIF presents How India Lends in association with CNBC TV18.